There are three factors, in my view, that are really driving the market right now: the dollar, the bonds, and of course oil, particularly on an intraday basis. So if you have a day where there's a bit of a break in the dollar and yields aren't rising, you can get rallies in the market. They become less sustainable when you have a rise in the dollar or a rise in yields. Oil on an intraday basis, the algorithms are still tied to them, and we can continue to expect intraday volatility based on oil. Today you had a inventory number. I believe there was an inventory number last night that was more bearish, and then the one today was more bullish. But I've been noticing, even with crude down, and crude held the tail end of the support range where it really needed to hang on to, which is, of course, the 49s. As long as 49s can hold, it is going to be a upward bias, in my view, to oil. If you break the 49 area, I'm just watching Tesla after hours, so let me flip over to the crude chart here. As long as we're below 49.33, which is a little iffy, but as long as we kind of hold the 49.15-ish level, it's all right. Today we had what I would consider a bit of a look below and fail. You had the rally back up, come back down, and then kind of just chopping. So that's going to be the key. Of course, the issue is whether OPEC will raise or lower their production in their next meeting. So I've said for a while I think that the bias for oil, at least until the meeting, is up. Afterward, we may have a sell the news event if there is no cut, and if it runs enough, it may be a sell the news event anyway. With regard to oil and pricing, if we can hold the 49s, I think we're going back up to 52s and eventually to 54s and maybe even 56s, more specifically 54.24 and 56.5. One thing about me, I am very precise with my levels, sometimes to the penny. If we can't hold, like I said, I didn't love the close today. This is now 2 days back to back below 49.33. We could revisit the 50 MA and the trend, or the backside of the old downtrend and the current side of the uptrend, which it won't happen tomorrow. It would take a few days, so that would roughly be around 46.80 by the time it got there. And currently the 100 MA is 46.65 and the 50 MA is 47.51. I've said if we don't hold 49s, we could see 46s to 47. So that's what I mean, that range. And in that area we would reassess. I would think it would probably be a buy the dip area. With regard to bonds in TLT terms, that was in CL terms, it's good that the bonds are kind of coming in ahead of the Fed. That's, to me, the same kind of trade that you have in oil. It's just the opposite side. The fear is that the Fed is going to raise rates in December, so they're going to keep kind of selling bonds into the Fed meeting, just as there's the fear that OPEC is going to cut production, so they're climbing oil into that. So that's the way I kind of see it. Bonds are kind of just holding up high. We are multiple days now, though, below the 200 MA, and we're kind of sitting on a channel within a channel uptrend basis. I think the real risk, if bonds are to kind of continue their downward path, and it's not going to be a smooth, clean path lower, my guess is they would probably bottom out somewhere around somewhere between 125.86 and 127.76. That will not go down well in S&P land if we already go down that low, but I do see the potential for maybe this is going to set up as like a big head and shoulders. That would be the neckline, and then, we would come somewhere up between like the 132s and 135s as a potential right shoulder. So I'm thinking that there is probably more to go in bonds, but it won't be kind of the end of the game there. You can see this trade playing out with S&P rotation. The financials have been having a pretty nice bid to them. Goldman Sachs and JP Morgan and that cohort have been doing very well. REITs and anything yield-based has been getting the smackdown. I'm also going to propose that the There's a little bit of election uncertainty that is coming into this. I know this is going to be controversial, and I know that I'm going to get tremendous amounts of hate and DMs on this. I am of the opinion that the market wants Trump. I don't think it wants Clinton. I think it's the opposite of what the news is telling you. I don't want to get into picking on anyone in particular, but the media has been exposed with a lot of bias in some of the WikiLeaks that have come out, particularly some of the people who work at some of the major television networks. Not going to mention any names, but that to me is coloring some of the coverage. For me, the issue is this, and let's forget the political ideology here. Let's just stick on pure market fundamentals. One candidate represents dead and stagnation, more of the same. The other one represents growth and entrepreneurship. And if you look at ever since that the betting polls have kind of blown out for Mrs. Clinton, the market has been pulling back. And that's because the market is realizing that there's going to be more regulation, there's going to be less growth, and there's going to be more debt and stagnation. And that's really when the market has started to pull back. Like I said, I don't want to get into the political ideology of this, but this is to me what is going on in the market. And when I speak to some people, I don't want to mention any names, but I speak to some traders on occasion, and this is some of the stuff that comes up in our conversations. Anyhow, that is my view. So I think there is some political risk here, and that is factoring into the market. So, will the Fed raise in December, or will they not raise in December? As of right now, and I've said this for a while, wrong browser. Let me pull this up. The probability of a rate hike is rather high, and I've said for a while that December was the risk of the rate hike. As of now, November is sort of a non-go. They're like meeting right before the election. It seems to me almost impossible for them to raise rates. It's about a 9.3% probability. December, however, actually, believe it or not, slipped today. It had been 72%, now it's 67.5%. I will tell you this. We will know at the November meeting, I believe, that if the Fed is going to hike in December or not. I'm going to try to make that call at the best of my ability based on the Fed minutes and the press conference. I'm sorry, there is no press conference. So I will have to kind of parse the Fed minutes. I always say that the Fed's, it'll be like porn. I'll know it when I see it. I don't know what the language will be, but they'll say something that'll tip their hand, I think, if they're going to hike. If they're wishy-washy, if I were them, and I was going to hike in December, they should be telegraphing that very vocally. So if it's kind of wishy-washy, I think that probability will come down quite significantly. I think we also have 2 jobs numbers between now and then, so if those numbers are crapola, I mean, maybe they change their mind. But as of right now, there's a lot of conflicting discussion within the Fed heads. And I'll tell you this, though, based on their last meeting minutes and the press conference and some of the statements that have been made by Janet Yellen, it honestly wouldn't surprise me to see them not hike in December. The data has been really, really crappy. They have yet to reach their inflation goals. They say that they might not reach it for 2 to 3 years. And the GDP data, the New York Fed just lowered their Q3 and Q4 estimates. So if growth is slowing, why would the Fed be raising interest rates? The rest of the world is accommodating and easing, and by the Fed just standing pat is technically hawkish. So it makes no sense to me that they would want to be looking to hike interest rates and further exacerbate the issue with the dollar. Let's discuss the dollar. The dollar could also be a fly in the ointment for the Fed as well. The higher the dollar, I know this is going to sound crazy, but stick with me here. Sometimes the market becomes a self-fulfilling prophecy. The higher the dollar rises into the Fed meeting, anticipating a rate hike, it might spook the Fed. So the higher the dollar goes, the less likely the Fed is to hike. If the dollar eases back, that might give the Fed a little bit of cover and room that they think that they can hike. So the dollar is currently in a pretty nice now uptrend again. It's sort of forming like a bat wing pattern, maybe even a W here. So I think the risk right now, at least short term, is up in the dollar. It is getting into some reference areas. I've mentioned that if you project a measured move, there was a lot of movement in between, but I'm talking end ranges of a measured move. You're looking at about 99.79, so the dollar probably has a little bit more room to run. I've said for a while I think it might even want to test par, but I think once it gets there, it's probably going to back off at least initially. Remember what I talk about when I say that things come up from the bottom. They sometimes they do break out. That breakout is suspect, and they often come back down because it's already moved so far so fast. The worst thing that the dollar could do now is consolidate here and then just start stair-stepping up. That would wreak absolute havoc on the market. So that's my view with the Fed and the components that the Fed is looking at. Okay, so we covered a lot of stuff already. Let's get into the major market indices. And then some of the momentum stocks that you guys had mentioned. Not all of these are momentum, but I guess most of them are. But let's talk about the major market indices. We have this push-pull in the market, and I know there's a lot of trader fatigue out there. I see it on some of the snippinesses of the messages I get from people, many of which who think that they are smarter than they actually are. But let's not get into that conversation either. So what's going on here? We are chopping in a major range. This really started about 3 years ago after the 2013 move of about 30%. If over time you average what a market return should be, it's roughly about 10%. We happen to have 3 years in 1 year, and now we've spent 3 years consolidating that. So it's kind of the law of averages. We've averaged it out a little bit. Why has the market remained high, even with growth slowing? It is simply because of the Fed. You have low interest rates, you have companies buying back stock, you have dividends, so on and so forth. It's the only game in town. Stan Fisher has acknowledged that. There's a little bit more nuance about the Fed, but I'm going to save that for the time being. I think it would be a better discussion a little closer to the Fed meeting. With regard to SPY, we're below one of the trends. We are below the old reference high, which was 213.78. We have, however, held the 211 and the 212.52 range. SPY is really breaking the trend now more by time than by price. It hasn't really broken down yet. It's acting suspiciously. It's acting kind of tentatively. You've had a couple of really wild moves. On 1013, you had a look below and fail. We got back up above that day's high. Then we kind of consolidated. You had a gap up and a fail. It came back down and then back up. 1024 was technically a look above range, which failed, and now we're back into the middle of the range. So really not that much has happened. I will say this, though. When you have look below and fails, you tend to rotate to the upper end of the range. When you have a look above and fail, you tend to rotate to the lower part of the range. I've said for a while that the market is consolidating to a little bit bearish here because we failed multiple times at the 50-day moving average, and now you have a couple of days now back-to-back closes below the 100-day moving average. I'll say this, if you can get above the 100-day, it kind of neutralizes a little bit. Anything below the 100, and I know this is going to sound extreme, the 200 could even be in play, which is down right now. It's moved up considerably down to its 107.5. I've talked about the Brexit measured moves even taking us down to 205 or 206. I'm not calling for that right away here. I'm not even sure that that will happen, but I will say when I talk about the risk of the move, is the risk to the upside or is the risk to the downside, until you get the market to clear and close above the 50 MA, the risk is still, in my view, to the downside. If we can get back up above the range here, this multi-day consolidation, it's now been since I have the box in, I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days, and then this big down bar. Like if the market, in my view, can get back up over 215.74, and right now the 50 MA is 215.75. If you can clear that area, I think that the risk now starts shifting back to the upside, meaning the market's risk is to the upside, not the downside. As long as we're below there, though, I'm still feeling a little bit squeamish. It doesn't mean that I'm not playing long positions. I do have some longs on, but I'm not going in a larger size, and I'm playing it very cautious and close to the vest, meaning shorter time frames and shorter swings. Meaning, like, if I normally am looking for 10 points in a stock, maybe now I'm happy with 2, 3, 4, 5 points. I'm taking, like, if I have price target goals, I usually have multiple ones. Like I think we can get here, where I talk about taking profits, I talk about here getting profits and here getting profits. I'll take more than normal at the first stage because I don't have confidence that I have the market wind at my back to get to the second and third tiers. So let's say I'm normally scaling out of a position a quarter, or whatever. Now I might get a half initially, and then maybe a quarter or so. Or even in some instances, the whole thing comes off immediately because there's been such a lack of follow-through. Like, you've had a few names that have gapped up big on earnings, like the PayPals, the FedExes, the Gap stores, although that today had a bit of a breakout above range, that have gone and they've just been consolidating. And normally, if I thought I had the market wind at my back, meaning a trend market, I'd be more comfortable holding those things. Now I'm kind of scaling more into scaling, meaning selling and taking profits on the positions because I don't know that we're going to get that next leg up. So that's what I talk about, context and backdrop. And that really comes back to the frustration traders are having, that they're trying to force the market to do something that it's not ready to do. You have to be trading the market you have, not the one that you want. And I realize it's choppy and frustrating and so on and so forth, but like 2013 was a home run derby market. You could have kind of swung for the fences and risked, popping out of your shoes because there were very little consequences. Now you have this like choppy mess, and I think that you should, if you could, this is a singles and doubles type of market. I was talking to a buddy of mine the other day. He said, how are things going? I told him I've been hitting a lot of standing doubles, which means you don't have to slide into second base. I've had a lot of solid singles, but a lot of standing doubles, like the Gap stores trade. I take it as a big standing double. If it were to now have range extension higher, that to me would be a home run. But trades like that. With regard to stocks that have reported already and done well and ones that have not done well, you're coming into the end part of the year. People need performance. They will chase the names that have done well, and they can be bought on dips. That's what I'm talking about. Gap didn't report yet, but they kind of pre-announced, so we have to see how that actually comes. So I'm kind of tabling that one for a moment. But the FedExes, the Boeings now that just broke out today, if you're like, you have a lot of mixed signals today. You have the S&P and the IWM actually closing below range just a bit, and of course we need a confirmation. I'll get to IWM in a minute. There's a nice trade set up there that I'm going to discuss in a moment that I actually am planning on doing. But you have a lot of mixed signals. You have FedEx holding up strong. The transports aren't really breaking down. You need that to really start to occur for the market to kind of come down. You have stocks like Boeing breaking downtrends. That's a huge component of durable goods. We have a durable goods reading tomorrow. So I would think that would color the report a bit. You'll probably have a decent durable goods order. I always look at it ex aircraft because I think it's too much with Boeing. I'm really more curious what's going on with autos and so on and so forth. And some of the other components that are in there, but we'll analyze that tomorrow, and I'll message out my views on that and probably cover it in the weekend review video. So there's a lot of mixed emotions here, kind of like Larry Wildman going off a cliff in my new Maserati, right? Props to anyone who gets that reference. Anyhow, that's the story. With regard to SPY, I think you can use today's high, anything over today's high, as a right or right out long. Anything below the low, I think you can maybe try as a bit of a right or right out short, just because today was a failed retest of the 100 MA and below trend. If we were to get back up above trend and back up above the 100 MA, I'm going to continue thinking that this was sort of like, you had the look above and fail, this was a move back just to the middle of the range, and now we're going to come back out again. More importantly, we still, ever by the hairs on our chinny chin chins, closed above the look below and fail day high. I know this is getting really wonky and it's tough to discuss on video, but write the level down, the 213.59. As long as we continue to close over there, it's still kind of like okay. I only am going to get really kind of into the freak out mode if we start losing the 212.15, 212.16, which was the body of that bar, and the pullback low, which was like 212.17. If you start losing that area, things are going to dramatically, in my view, shift to be more bearish. So now we're kind of just more neutralized. IWM not looking pretty. A close below trend and a close below the last swing high. Swing low, which was 1988. Today's, let me zoom in here. I'm looking at this. Today's close was just below at 1973. One close below isn't necessary, and also, by the way, we're below that old reference high of 120.58. Anything below there, you know I'm more cautious. I've mentioned this for weeks. Today was a close below the 10-day, a close below the trend, and a close below the consolidation range of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. So we haven't, this was one close. It doesn't necessarily mean there's going to be continuation and follow-through, but I'll say this. Anything below, I think anything really below 120.10 is a little iffy in my book. You know, if we were up early tomorrow and we had like another test somewhere between there and the 100 MA, I wouldn't mind even like a quick right out short. But I'll say this. Today has the potential to be a look below and fail, but it also could be a look below and accept if tomorrow is down also. I like today's range as a gauge. Anything above 121, I like long. Anything below 119.46, which was the low of the day, I like short, for a move down to the 117.37 level and potentially even articulate its way down to the 200 MA. So that's IWM. The Dow kept things high. I don't really want to cover DIA, but I will say this. It's holding a longer-term trend that I have drawn in from the Wayback Machine that's very proprietary. The 200 MA there isn't even that far below, but the Dow is just a handful of stocks. I don't really like to get too crazy about it, but again, still below the 50 MA. 50 MA here is so key, and we are still below there. The Qs. So the Qs had a bit of a two-day island reversal top. One of my guys who follows me, who uses some technical stuff, says he got some kind of big reversal sign. It's possible. I mean, Apple today for sure didn't help. The difference, though, is that the Qs are still above the 50 MA. So when I like to pick a schoolyard fight, I like to pick on the little kid, not the big one, because the big ones hit back hard. And these stocks can knock your block off. So I'm a little cautious here on the Qs, but it's still, this was to me just a bit of a look above and fail. We're back into the middle end of the range. We're still holding some trends. We're still above the downtrend. And you're still into the gap from the, kind of the Microsoft. It kind of filled the gap and then closed back into it. So to me, the Qs are still a little bit inconclusive. It's hard to get too bearish on the market when you have stocks like Microsoft. It's still above its dot-com bubble high, which was 59.97. I've said for a while I thought it would achieve the 1.618 Fibonacci extension with 62.17. We got pretty close. Microsoft has moved up from basically 48.03 all the way up here. It should be taking profits. I do think that the stock could maybe work its way higher, but we're getting kind of closer to the end target ranges here. The channel high is roughly around 64. I mean, the best thing, in my view, Microsoft could do here is just consolidate a little bit. It is technically just a breakout. It did just consolidate quite a bit, broke out of range, but that seems to be the technical pattern for this thing. So I'm expecting some chop. I actually like the idea of selling some near-dated strangles in the play, meaning out-of-the-money calls and out-of-the-money puts. I think that this is going to stay high, like that song, right? High all the time. So I think it's going to stay high for a while. It's also going to be viewed, in my estimation, as a safety play. It's one of the ones that had a good quarter and went higher. Apple. This did not act so well, although I will say a couple of things about Apple. It was a pop and flop, and in after hours it achieved the 121, which I said I thought it could, which was the channel high. It opened up low today. It should technically, in my view, should have gotten down close to the 50 MA. It wound up closing near the high of day today. I think you can use today. Apple loves to fill gaps. So I think if you could get above today's high, which was the 115.70, it will likely fill the gap. Where it goes from there, I can't tell you. Below the low, well, I could tell you, but I'll save that for the weekend review video. But I would think the gap fill would probably get sold, at least initially. The 113.31, I was really disappointed that Apple closed well. Like I said, it kind of found it found its voice today, and it closed well. I would have liked to have seen a 50 MA test, though, which was around 112.05, and that would have been exactly the trend and channel low. 112.39 was sort of the breakout. So as long as we hold in that like 111, 112 area, there's really not that much to see. If you start losing that area, we will see 109.85 to 110 quickly, and I think eventually work the way down to fill one of the gaps to 105.44. I'd be a very motivated put seller down there because the 200 MA is now swinging back higher. It's in the key 103s. 103.74 was a key level in the Wayback Machine. I keep a lot of these levels. I think that area people would be freaked the F out, and it would be a good opportunity to buy. So here's my critique on Apple, its CEO, and the quarter they just put up. I think the quarter was okay. They had a small revenue miss, but they had a little bit of an EPS beat, and their units were roughly in line. The stock had run a lot off the lows. I mean, keep in mind, this stock had come up from 89.47 and was already pretty close to the resistance, 119.75 to 121. And I think people just were prudent, and they took the opportunity to sell. I did a poll ahead of time. 58% of the people were bullish on the stock, and it tells me that they were already long. I like when people I kind of do the opposite of those polls, as crazy as it sounds. Because it's all, to me, earnings is a matter of positioning. There's an old movie I liked from, I think it was the late 80s or the early 90s with Richard Dreyfuss called Hot to Trot, and he would figure out who wins horse races by going out in the crowd and asking everybody, and then the horse that nobody picked, he bet, and it was the one that wins. So it's sort of the similar type of situation with earnings. Keep in mind, it's all a matter of inventory positioning. Everyone is already long. They're looking for the next greater fool to pay up. They're already in. There's no fools left. If everyone's bearish and and they've been sold out or they're short, the opportunity for an upside surprise or a stock move is higher. That being said, I think Apple handled itself very well today. 115 is key. If it loses 115, I think 111, 112. If it holds 115s, I think it fills the gap. So we'll keep it that simple. I take it from level to level. I don't assume. Just because it's going to test the 50 MA, I don't assume it's going to break. I always assume it's going to hold, at least initially. I think it would be. I actually had my fingers crossed today that we were going to open on the 50 MA. Can't always get what you want, but an open on the 50 MA to me would have been a screaming buy. So that's the story with Apple. With regard to their CEO, Tim Cook, I read a really interesting article that compared him to Steve Ballmer. I think it's actually a really interesting comparison, and I would say he's sort of a cross between a John Scully and a Steve Ballmer. He just doesn't have that visionary view for Apple. He's not exciting the street. The street wants to buy companies with a space program. As crazy as that sounds, they want the vision. Bezos and Amazon, Google, they have space programs. Those stocks are doing really well. I don't literally mean they need a space program. I sort of say that facetiously, but what I really mean is that they need a product or they need some new component to the story, not just better S-model iPhones that are incrementally a little bit faster than the last. They need some new functionality, a new business line, something for the future. They're so busy defending what they have now, they're missing the cloud. Like Microsoft missed mobile, Apple is kind of not really making it in the cloud. I mean, they're doing okay with it, but they should be doing more. Why don't they own gaming? Why doesn't Apple TV own the gaming market? Why are Nintendo and Sony and Microsoft still even in the game? Everyone has an iTunes account. They could buy games directly through there. You could play it on your phone or some type of a device app, or some type of an apparatus like the new Nintendo Switch, which I think people think is going to be a bust. I think it looks kind of cool. But Apple should do something like that where you could plug your iPad in and play it on your TV and then pick it up and, it's mobile. Something along those lines. Why haven't they rolled up Pandora and Spotify? Those are no-brainers to just take competitors out of the market. Why aren't they competing with a subscription service to take on Netflix yet? Amazon has already started. Amazon, I'll get into Amazon in a minute, but that's my view. I think that's the story, that Apple is going to kind of languish with this lower PE until they can prove, I guess it's guilty until proven innocent. And I think, unfortunately, Tim Cook is a very capable guy. I think he's a pretty good CEO, a great supply chain manager, and so on and so forth, although it's a little disturbing that they couldn't produce enough phones. I don't know if they had anticipated the demand or what have you, but they need something new. They need what's next. And without Steve Jobs, that's kind of what the issue is. People have flowed into other guru stocks like Amazon. I had a debate with a gentleman on Twitter the other night who was telling me everyone's getting good at the web and so on and so forth. This is not true. Amazon Prime is the new Sam's Club. Like Walmart has Sam's Club. Amazon Prime is the new Sam's Club. You get their streaming video, the free shipping, and God knows what else, discounts. God knows what else they're going to throw into that. That is the future. And everyone keeps saying, that other people are going to catch up. If it was so easy, why haven't they? I think what Amazon has built, the infrastructure, they are years ahead of their competition. I do think that the stock is getting a little, I don't want to say a little bit ahead of itself. They'll probably split the stock and it'll go higher. But I've said this, that we've reached my end range targets, which were 833.91, which was the 1.618 Fibonacci extension. I had said that for a while. The max upside I'm seeing if you take a measured move and project it from one leg to the next would be 885.19. This to me is like sort of in the sell zone. It doesn't really get bearish until you start closing below the 50 MA. Ideally, I would love to see this thing like puke out ahead of the quarter and set up for a right or right out long. Keep in mind that the last time Amazon had one of these kind of mammoth runs, it had a 222-point pullback to what now is trend. If that were to happen again, we would roughly test the breakout area into the 696s and 675 range. I don't know if we would get all the way down to the 638s, but that area to me in the 6s and the 200 MA, which is down there, if there was to be some kind of crazy gap down or something in Amazon, I would be an interested buyer again down there. I think they're going to kill it in the holiday quarter. I'm not saying the stock can't go higher. It could go super parabolic. Maybe it gets to 1,000 if they do the stock split like 10 for 1. People aren't going to think too much about buying an $85 stock, and it'll be 100 very quickly, kind of like what happened with Baidu back in the day. But as for me, as for my discipline and technicals, we have achieved what we needed. We've walked on the moon here with Amazon. That's the Amazon. Google. This is one that I still think has some room to run. It had a bit of a look above and fail. I'm loving that this is pulling back on the Apple issue. I think that this is going to achieve 895.44. That's the 1.618 Fibonacci extension from the 2 high to the 623 low, projected higher. It also coincides with the channel high. So I'm thinking that we're going to have a gap. I could probably have a gap up, but I think it might be a gap in crap, like a gap to sell. They report tomorrow. I think that the safer bet for this is obviously a call spread or some kind of a call ratio or call flies same week. I really wish this was reporting Friday because it would be like same day expiration. But I like the idea of kind of like buying one and selling two or three up there to the same week expiration, or just selling some out of the money puts to take advantage of the juice, maybe something down around like the 732s if there's juice. I have to check. That's the that was the 61.8. I have to adjust this now for the move up. So if you bear with me a minute, I'll do that quickly. 838.5. The new 61.8 would roughly be 736. So no big deal. That was sort of like the breakout region. So I'd be into selling some out of the money puts there if there's some juice. Let's take a look if there is, because I kind of like that trade. Not too much. The expected move is about $40, so it's all right. I'm okay with it if it's same week. I think it would be okay. I don't think it would just completely fall out of bed from there. So that's my view on the Goog. And I talked about Amazon. Some of the recent blow-ups in the market. Let's talk about like the Under Armours and those kind of stocks. And even Tesla reported. So Tesla. Let's do Tesla quick because they just reported and it's really fresh in my head here. They blew out their quarter. It was really phenomenal. Elon Musk is clearly trying to get the stock higher. The problem is they need to do a capital raise to fund the Solar City deal, and that is going to weigh heavily on the stock. The stock really broke down from 216, and the 200 MA is roughly 213. If you look after hours, I think that was really roughly around where it kind of topped out. So maybe you squeeze the shorts if you can clear 216.45, which was the after hours high, and maybe it would gun itself back up to 230. But my take on this is that it's going to be choppy until they do the capital raise. So I actually like the idea of selling out of the money calls and out of the money puts, or out of the money call spreads and sell out of the money put spreads. The Iron Condor or a Strangle. I think that the stock is going to be range bound for a while. Under Armour fell out of bed pretty nastily. The stock has been in a pretty cruddy pattern for a while. And yesterday you kind of gapped down to the range low, and today you closed, I think, almost on the dead low. So this looks pretty bad to me. The 61.8 is 27.97. It's also the channel low. I would be an interested buyer roughly around there. I don't know if it's going to fully get there. There's some support around 30.99. It's a lot. I like how do I like playing this? I like playing put ratios, meaning you buy one and sell two out of the money. I'm looking to get long this, but lower. Into that kind of pocket into the 20s. So that's my thinking. I think that the tail risk here would be like 23s to 20.70. It's far, I know, but the company still trades really, really expensively. It's still, I'm seeing it at 82 times earnings here. I think I don't know if that number is accurate, but that's a lot for a company that's kind of in a declining cycle here. So I think that this is going to see that somewhere in the I know it's a little cray, but I think this is going to see somewhere in the 20s, the mid to high 20s at the least. There was some reference support. I think it's going to kind of stutter step around the 30s, but I would be surprised if this doesn't have a two handle on it. I'd be interested in kind of buying it down there. I feel like I missed a lot of the decline, which I still think is coming, but somewhere between that 27.97 and like that 23 area, I'll be selling some out of the money puts into that area. I don't think it's going to be a clean move because it's moved a lot. I think it's going to go down a few more days, then it's going to kind of try to come back up, but yeah, I'm waiting for lower. What else was it? Someone asked me about a Hertz. I sold some puts in that the other day. This is kind of a crazy stock. I had been debating with a follower of mine on this near the dead low, and I looked at the chart and I'm like, the risk reward. Like, I don't think longer term this is such a great business model anymore with Uber and Lyft and Uber now is going to have flying cars at some point, or planes in the future. It seems to me like the rental market is not doing so great, but I know Carl Icahn is involved in this and a bunch of others. So I happened to be long this, and I sold it out at 50. I was about $3 early, but I've been waiting to buy it back in the gap fill, so I sold some puts when it was around like the 32, 37 level, and I'm just playing it for a bounce. Yeah, that's about it. They report earnings on 11/3. I don't know if I'll still be long then. I'll let people know if they're curious, but maybe this makes a run back up to the 50 MA or what have you. So yeah, that's sort of what I'm thinking. I guess the downside risk here would be a retest into the the mid to low 20s, but I tend to think that this area is probably going to hold for a little while. Yeah, that's just my take on the Hertz. So I had sold November expiration. Actually, it's a little long for me. 30 puts, and they've been cut in half. So I'll probably book this ahead of the quarter, is my guess. Probably a day ahead, because it's hard to get filled. The IV gets kind of jacked the day of. So that's my thinking with Hertz. It's pretty good. I like when short puts get cut in half. Someone asked me about Alibaba. I'd love a shake and bake in this. It's still holding above the 50 MA. I talked about this reaching 110-ish. We got pretty close. I was in a risk reversal call spread. I had closed that, and I had left the calls, but I had left the puts on, and I just took those off the other day for a pretty nice gain. All in all, that was a really, really solid, a towering double or whatever. Definitely a standing double. I would like to see this pull back ahead of the print to set up for a long. Like, there's a lot of like late to the party chasers. This could easily, believe it or not, pull back to like the 93s and 96s. That would be the kind of the ideal setup. Everyone will think the gap is going to fill, and then it just kind of only comes down to like the 100 MA, and then it's off to the races. But 50 MA plus, it's still okay. But I'd love to see this come down. I don't know if we have enough time for it, but that's my take. I'm kind of waiting on BABA. I do think it could eventually. I think it will see the old all-time high again at some point. I just don't know that we don't need to move down first. That's we basically got my price target, and I'm kind of just sticking to it. Speaking of price targets, and I love to be an I told you so. Most people say I hate to be an I told you so, but I love to be an I told you so. It's sort of I'm half kidding. But I will say I told you so. 65.94 in Twilio was 2 times the range. I'm going to go over this in major depth in the weekend review video, but I wanted to tease it by saying once you, if you're a biblical person, you should know the story of Edith, basically, which was Lot's wife, and she looked back at the city of Sodom, and she was turned into a salt pillar. Often with these IPOs, once you reach your target, you sell and you don't look back, or you get turned into a salt pillar. You can often miss a few more bucks. This actually came down quite dramatically, and I actually did talk about a kind of a second look, which worked. But for the most part, the point is when you've reached your target with the IPOs, you don't look back, or you get yourself creamed. The stock today, and let me tell you something, when I was selling it up there, when I was telling people to sell it up there, I had people telling me, you're nuts, it's going to 100 and blah, blah, blah. I haven't heard from any of those people. The stock is 39. That is a huge, huge difference. So they did an IPO, a secondary at 40. There's a reference kind of low around 37.20. It needs to hold this area. If it doesn't, it's going to retest 23 bucks in my view. It might even go lower. Who knows? God knows how many secondaries they have to do. I think this may or may not. If someone wants to correct me, it may have been a sliver deal where they did a few, where they did some partial shares, and then it's been weighing on it ever since, and they've been selling more. Sort of like what happened in Shake Shack, which we're going to cover in a minute. So this $37.20 to $48 area is very key. I actually think short term, just because this has come down so hard, so fast, I mean, it's sailed, I mean, we're through the 61.8. I think somewhere around the 33.78 is the 78.6. I have to see what the premiums are. But I think you could probably sell some like same week or next week out of the money puts and be like kind of like okay. If you own it, you need to hold that $37.20 to $40 range, or else God help you. I don't even know why you're still in the stock though after the sell call. Often these stocks double the range, and then once that happens, it's lights out. So we'll leave it at that. I'm going to go detail that one though more in the weekend review video. Anyhow, let's wrap on Shack. I have a few out of the money puts. Actually, they're basically at the money, and I think some might even be in the money at this point, which is not good. 30 is the old reference low. This is basically a kind of an arc pattern here. I like that it's down into the earnings, right? It's basically, it had gapped up on the last earnings, and now it's been selling off ever since. For me, this is a longer-term play. What I do with this is I sell puts when it's low. I let it rally, I buy them back, and then it comes back. I've done this now for a while. I mean, for the better part of a year, maybe even 2 years at this point. But it's worked, so I like it somewhere close to the between here and 30, I guess. This has been the reference low. It's getting kind of extended to the downside, and I think it's been suffering because of like the likes of like Chipotle and so on and so forth, and Sonic. But Shack is a pretty good business. I think that the stock eventually will see higher, but again, this is one of those ones where there was the IPO, and I think they had some secondaries, and they now have, someone can correct me if I'm wrong about that, but I think that this stock will eventually kind of grow into its multiple. So I like it kind of as a longer term hold. That's my, as a premium play and as a longer term hold. Actually, I told a fib. I'm going to end on Chipotle. Wow, another one. Ackman is getting his you-know-what banged in. This thing consolidated in this like low range really for a while. It was like basically since July, I want to say, maybe even earlier. I mean, this thing for a year has basically been in this range, and today was a gap and go below the range. That's really not good. It had broken trend, and it had been struggling to try to recapture it. It couldn't get back up over the 200 MA, which I said was key. Now it's below, and it to me looks it doesn't look good. I think that this could get to as low. The 61.8 of the entire move is 312.57. I'm going to look in a longer term chart pattern. That's the 61.8, and then where the run initiated from was 233.82. Wow. This just looks terrible. I hate to say it, but this just looks really, this is an awful chart. It's probably going lower. I mean, if you could clear today's high, like if there was some kind of news and you got back up above today's high tomorrow, I would consider it a look below and fail. But anything below 384.77 to me is vulnerable. If you, like I said, if for some reason there's news tomorrow and we gap up above there or open low, like if there are tweezers, you open at the low and then close above there, I would say today was a look below and fail. As of now, I have to assume it's a look below and go, and I think we're going to be targeting that 312.57 to 233-ish range. I'd be an interested out of the money put seller into that area. So that's what I'm thinking with regard to Chipotle. On a side note, they opened a Chipotle yesterday in my neighborhood, and I ate there today, and it was pretty empty. It's weird though. It's a weird location. It's like on a side street near a Whole Foods. It just opened, so it's the food was good. I haven't since the controversy with Chipotle had started. I haven't been eating there. I've been eating in like a Dos Toros or some of the competitors, which are truly not that great. I think Chipotle is better. It was really good. The food was good. I'm not sick from it. I'm just joking. I think that they are going to have to earn earn their stripes, earn their respect back. I know that they're introducing more menu items, and I heard analysts on the call kind of pillaring them for that. I mean, Chipotle's menu is a little bit boring. They only have tacos, a burrito, and a salad, and it's basically all the same ingredients, which I think has helped them to be a little bit more efficient. But I think it would behoove them to add on a couple of more menu items. Maybe they'll be a little bit more popular. But yeah, I mean, like I said, needs to get back up over that 384.77, or it's going to continue lower. Anyhow, that's my story. I'm sticking to it. If you missed this video or only caught part of it, it will be on my YouTube channel shortly. I'm going to post it now. If you're not subscribed to my YouTube channel, it is Justin Pulitzer Trades, and my Twitter handle is @JustinPulitzer. I always suggest people to subscribe there, and then you get to see how this stuff is done. Just watching this Tesla after hours, it basically got up to the breakdown level and backing off, and like I said, I think this thing is just going to be a choppy, bloody mess. The shorts are not going to let up on this thing until they do their secondary. The minute Musk mentioned that secondary, he should have done it. It's just, I don't know what he's doing. Anyway, that's my story. I'm sticking to it, and cheers.